David Fyfe, head of oil industry and markets at the International Energy Agency, joins us on the phone now from Paris. And I just want to pick up on that point, David, about the European debt crisis shaping dynamics in the oil markets. If things were to get worse in Europe, what would you expect to see?
Yeah, I mean, we have indeed trimmed our expectations for economic growth for 2012, which are coming in just below 4% now, about 3.9% globally. But obviously, you know, the risks lie to the downside, and so we're running alongside that a weaker GDP sensitivity of about 30% below that, so 2.7, 2.8 globally. And that really would eat into oil demand growth for next year. Just for clarification, we've cut our 2012 oil demand number by about 200,000 barrels per day, but we still have growth globally in oil demand next year of about 1.3 million barrels per day. So there's still robust growth there, but it's being affected by this economic slowdown, no doubt.
David, given the slowing growth situation that you described, can you tell me what is going to drive that robust growth then?
Well, there's still a degree of resilience in the non-OECD markets. We've trimmed slightly our outlook for Middle Eastern demand growth, but you know, high prices there, subsidized end-user prices in Asia, the Middle East, and elsewhere means that consumers there are not paying $80 or $100 per barrel for oil. They're only paying a fraction of that amount. And with still buoyant economic growth in the non-OECD of 5 or 6% next year, then that's going to carry on driving robust demand in the developing economies.
What about then concerns that have been, I was speaking to some CEOs yesterday at Oil and Money Conference right here in London, saying that one of the big things on their mind right now is that actually we won't see that sort of robust growth from emerging markets. The danger is that we will see something of a slowdown that could potentially affect their demand for commodities, particularly oil. Is that a scenario that you envisage happening?
I mean, it's a possibility. It's not our base case, but we flag very clearly that if economic growth is slower than this global 3.9 benchmark that we're running, then oil demand growth will be slower, and it could come in at less than 500,000 barrels per day of growth for next year. That's a very different sort of set of oil market dynamics from our base case, which still has fairly robust demand growth. So we acknowledge the possibility, but we don't think the balance of probabilities is yet tipped towards that you know, much weaker economic growth picture for next year yet.
All right, so you're cautiously optimistic. I think that's fair to say, isn't it? Also, I want to ask you about comments that we're hearing from Iran's OPEC governor. They're saying that Arab OPEC members should cut back on production. Of course, they ramped up production to make up for the shortfall of Libyan oil when that came off the market. Would that be a mistake?
We think it's just a little bit premature to be making too many judgments about the recovery of supply from Libya. Now, progress has been made over the last month or so. Production has recovered to nearly 400,000 barrels per day. I think it's interesting to read this morning that the former oil minister in Libya is sounding a much more cautious tone and saying, you know, if they get to 550,000 barrels a day by the end of the year and 1 million barrels per day next year, they'll be doing very, very well. That chimes really quite closely with our view, or our assumption anyway, about the recovery from OPEC. So I would say to other OPEC producers, it's maybe premature to be talking about slashing output because of increased Libyan supplies. Let's see how quickly and how sustainable renewed Libyan supplies will be.
All right, thank you very much indeed, David Fyfe, IEA head of oil industry and markets.